Stephen wasn't rich. He didn't have a trust fund, insider tips, or a fancy finance degree. He was just a regular person with regular bills, regular responsibilities, and one big question that kept coming back every time he looked at his bank account. Is this all there is? Like many people, Stephen believed investing was something only wealthy people did. He assumed you needed thousands of dollars to even start. But one night, scrolling through articles and videos, Stephen came across a simple idea that changed everything. What if investing wasn't about starting big, but about starting consistently? That's when Stephen noticed a familiar name, NVIDIA, ticker symbol NVDA. He had seen the logo before. It was on graphics cards, gaming PCs, and now everywhere in conversations about artificial intelligence. But Stephen didn't rush in. Instead, he asked a small, powerful question. What would happen if I invested just $25 a week into NVDA and stayed consistent for decades? $25 wasn't life-changing. It was a couple of coffees, a fast food meal, or a subscription Stephen barely used. But unlike those expenses, this $25 had the potential to grow. So Stephen made a quiet decision. No hype, no pressure, no shortcuts. He would invest $25 a week into NVDA and let time do the heavy lifting. This video follows Stephen's journey. Not a get-rich-quick fantasy, but a realistic story of patience, consistency, and long-term thinking. Along the way, we'll explore what NVIDIA is, why it matters, how it compares to the S&P 500, and what steady investing could realistically grow into over time. This isn't about luck. It's about math, discipline, and time. And it all starts with Stephen's $25 decision. Before Stephen invested a single dollar, he wanted to understand what NVIDIA actually did. NVIDIA isn't just another tech company. It's a core infrastructure company for modern computing. At its heart, NVIDIA designs graphics processing units, or GPUs, which are specialized chips built to handle massive amounts of data at incredible speeds. Originally, GPUs were mainly used for gaming. But over time, something powerful happened. The same chips that made video games look realistic turned out to be perfect for artificial intelligence, data centers, machine learning, self-driving cars, and advanced scientific research. NVIDIA didn't just benefit from this shift, it helped create it. Stephen realized NVIDIA wasn't selling a trend, it was selling tools. Tools that power entire industries. From AI models and cloud computing to medical research and autonomous vehicles, NVIDIA sits behind the scenes, quietly enabling progress. This is why NVIDIA is important. It doesn't rely on a single product or customer. Its technology is embedded across gaming, enterprise computing, AI development, and global data centers. When demand for computing power increases, NVIDIA benefits. Stephen also noticed something else. NVIDIA reinvests heavily into research and development. It isn't standing still. It's constantly pushing innovation, improving performance, and staying ahead of competitors. That matters for long-term investors. To Stephen, NVIDIA wasn't just a stock symbol. It was a company positioned at the intersection of technology and the future. That made it a compelling candidate for long-term investing, even with small weekly contributions. Stephen had heard the advice many times, just buy the S&P 500. And it's solid advice. The S&P 500 represents 500 of the largest companies in the U.S. economy and has historically delivered steady, long-term returns. But Stephen wondered, how does NVIDIA compare? When Stephen looked at NVIDIA's growth history, the numbers told a powerful story. Over the last 3 years, NVIDIA delivered an average annual growth rate of 21.84%. Over 5 years, it averaged 14.55%. Over 10 years, NVIDIA grew at 15.81% annually. These numbers exceeded the long-term average of the S&P 500, which historically sits around 8 to 10% per year. That difference may not seem dramatic at first, but over decades, it becomes massive. Stephen understood something important. Higher growth also means higher volatility. NVIDIA can rise fast and fall fast. The S&P 500 is smoother, more diversified, and less dramatic. But Stephen wasn't chasing short-term gains. He was focused on time. By investing small amounts consistently, Stephen could ride out market swings. He didn't need perfect timing. He just needed commitment. Compared to the S&P 500, NVIDIA offered higher growth potential for someone willing to stay invested long-term and ignore short-term noise. The power of consistent capital investment. Stephen mapped out his plan clearly. If he invested $25 a week, his yearly investment would be $1,300. Over time, the numbers stacked up predictably. 5 years, $6,500 invested. 10 years, $13,000 invested. 20 years, $26,000 invested. 30 years, $39,000 invested. These numbers felt manageable. Stephen wasn't stretching his lifestyle. He was simply redirecting small amounts of money into ownership of a growing company. But the real surprise came when Stephen looked at growth, not just contributions. At $25 a week, after 5 years, he would have invested about $6,525. But his portfolio could grow to $37,599. After 10 years, $13,025 invested could grow to $420,108. At 15 years, $19,525 invested could become $3,312,648. At 20 years, $6,509,733. At 30 years, nearly $19.4 million. Stephen didn't assume these numbers were guaranteed, but they revealed what compounding can do when growth and time align. Stephen also imagined different versions of himself, future Stephen earning more, saving more, and investing more. At $50 a week, after 30 years, $70,450 invested could grow to $38,978,259. At $100 a week, $140,900 invested could grow to $77,956,519. At $150 a week, $211,350 invested could reach up $116,934,779. At $200 a week, $281,800 invested could grow to $155,913,039. At $300 a week, $422,700 invested could grow to $233,869,558. Stephen realized something important. Wealth isn't built by one big decision. It's built by many small ones, repeated consistently. Increasing contributions simply accelerates the process. Before ending his journey, Stephen reminded himself and anyone listening of one crucial truth. Disclaimer: this video is for educational and informational purposes only and should not be considered financial advice. I am not a financial advisor. The examples and opinions shared are based on personal research and experience. Investing involves risk, and past performance does not guarantee future results. Always do your own research or consult with a licensed financial professional before making investment decisions. Stephen's story isn't a promise, it's a possibility. A demonstration of what can happen when discipline meets time. You don't need to start big, you just need to start. In the next video, we'll explore ETFs like QQQ, SPY, VU, VIG, VGT, and SMH, and compare which investments could help you build long-term wealth starting with just $25 a week. If you found value in this story, please like and subscribe so you don't miss what's coming next. Thank you for watching.